In this week's update, Bitcoin, silver, copper, rare earths, platinum, the impressive movers of the week. New multi-decade highs in copper, and it's technically a big deal. And tariff impact on inflation about to be seen. My name is Garry Davis. I'm an authorised representative of Primary Securities, and the information in this video is general information only. Another fascinating week. So let's start with a perspective on what's been happening. The US indices are back at record levels. So it begs the question, which plenty of people are asking at the moment, is all this justified? And we've got certainly some conflicting signals from the market. The bond market is betting on rate cuts, probably because it's expecting slowing growth with the impact of everything that's going on. Whereas the stock market is betting on growth accelerating, otherwise it wouldn't be at new all-time highs. So that is an interesting conflict that is going to play out over the next couple of months, maybe even the next couple of weeks, because US earnings season is about to start, and one of those two major markets is going to prove to be wrong. Now, normally the bond market is more correct than the stock market, but we'll see. So the short-term perspective is really quite interesting. July is almost always positive. So that is a real big tick for the next couple of weeks through to the end of July. But all bets are off because we've got a couple of things coming up, one of which is earnings season, and the other one is some economic data coming up, and I'll get to that in a minute. But look, US breadth is strong enough. Now, certainly there's no question that stocks like NVIDIA are driving the NASDAQ and the S&P to those record levels. But if you look across other sectors, the breadth is still pretty good. It's not like this is only about the major leaders. There are still some stunning performances in the American market. But look, the June CPI is critical for stocks because it's really the first set of data that's really going to reflect the new tariff environment. Now, the impact may not be fully felt as yet. We might need to wait another couple of months for that impact to really flow through. But certainly the June CPI is going to have an element of the tariff increases, and therefore it's critical. And that could change market sentiment on a dime. At the moment, the expectations are the June CPI will be up plus 0.3%. In May, it was plus 0.1%, which was a bit below what was expected. So 0.3 is the magic number. That's current consensus. And so one would expect that the market won't react a great deal if it comes in around that level. If it comes in a bit hotter than 0.3, then look out below. There could be some nasty action. But that's all just possibilities at this stage. So the logical conclusion, which I don't place a lot of stock in until I see the evidence in the charts, is that we're going to have inflation up. That's the overwhelming probability. You can't do all the things that are being done with tariffs and a falling US dollar and all the other things that are happening and not impact inflation and also not impact growth. So it's logical to assume that inflation will rise, growth will slow, and that is the definition of stagflation, which is the worst scenario for the stock market. Now, there's no guarantee that we'll end up in that situation, but that is certainly where the betting is at the moment. So whether the Fed puts rates up or down depends on which one appears first and which one appears to be the strongest influence. But one of those two things is going to manifest itself, and that will set the market sentiment for the rest of the year. So we're in a very critical period at the moment. But as we know, logic doesn't always provide the right answer in the short term. Sometimes markets don't do anything. Sometimes they do the opposite of what you would expect because it's already been priced in. So we never know that until after the event. So we don't want to overplay the logical conclusion, which is what a lot of investors do and why a lot of investors spend a lot of time trying to anticipate the next correction, and it generally impedes their portfolio substantially. So it's just something to be aware of. It should be something that puts you on alert, not to get complacent. it raises the question whether the new megatrends around AI, around decarbonisation, around nuclear, around defence spending, whether those new megatrends are distorting the norms. So in other words, we're going to have higher levels of real growth, not just growth that's anticipated by the stock prices going up, but real growth in earnings. And is that going to distort the norm? Are we now going to see earnings on a higher plane than what we've traditionally seen over the decades? We don't know the answer to that. It's possible because there's certainly some additional concerted spending like we've never seen before in each of those areas. You know, we've never seen AI investment to the degree that we have. Certainly, we're going to see defence spending at a much, much higher level. And of course, the energy transition is something like has never been attempted before. So it's possible that we could see these megatrends drive earnings growth at an incredibly high level. So the prudent course of action when you think about all that is to do what I always do, and that's rely most heavily on what the money flows are saying to guide our weightings and our exposure. But there's one other element that you need to factor in as well, and that is your purpose as an investor. Are you going to ride through these sort of temporary corrections? And if you recall what I covered last week, anything less than 6 months impact on the stock market, you really don't need to worry too much about if you own quality stocks. Just pretty much ignore it and ride through it, because trying to get out and then get back in again with quality stocks that are going to fall less and rebound fastest is a bit of a wasted effort, and you'll probably end up worse off. So that's really the distinction for me. If I perceive that the environment is likely to be negative for a period of more than 6 months, then I want to do something about it. It may not be drastic, but I want to do something about it. I want to maneuver my weightings and my exposure around a bit to allocate that. But at the moment, we don't have that evidence, and the evidence should not be coming from the logical conclusion. The evidence should be coming from what the markets are actually doing. And as you'll see in the charts in a minute, the markets remain remarkably calm. So my recommendation is that investors have a state of heightened awareness. There's no requirement to do anything yet until the market shows us, but just be more aware than you otherwise would be if there is any shifts in the character of the market. They're the things that I look for, that the market is changing its character. And of course, as usual, we recommend that you get all the required advice that you need, be it investment, financial, legal, or any other advice before you act on anything which is contained in this video. American stocks, the S&P was down 0.3 for the week and the NASDAQ 0.1. So it was a bit of a breather week, even though we're still at these record highs. Commodity prices are on the rise, and the impacts there are from geopolitical forces, from sanctions, from tariffs, and of course from the downtrending US dollar. So there's many impacts on the US market at the moment, but certainly commodity prices may be on the cusp of a new period, such as we saw in the early 2000s. The flow-through impact of higher commodity prices just really has to be inflationary, because it impacts so many things. It impacts virtually every aspect of the economy. So if commodity prices are going to rise, then we're certainly going to see higher inflationary forces. But the earnings season, which starts on Monday in the US, is going to be a really big one, because there's been many things that have changed in the last 3 months. And so some of those impacts will be starting to flow through to earnings, but particularly profit margins. That's going to be the critical one that I'm going to be watching. Are companies not putting their prices up because they're absorbing the tariffs and they're absorbing the higher inflationary costs? And that's quite possible, to maintain their output. But there's only so far that you can push that game. So profit margins are certainly going to be a critical one to watch in this earnings season. Now, the US dollar, I think that should be slightly higher. I think it actually did edge up a little bit, 97.87, but we'll see that in the chart in a minute. The 10-year yield edged up to 4.41, and the VIX index actually dropped back a bit and was at 16.4. So let's jump in and look at the charts. We'll start with the NASDAQ, which is, because I'm so growth orientated, that's where I always start. And you can see that the NASDAQ, we've got a lot of very short range days. We haven't had any significant days or gaps for some time. So this was a really concentrated little period of price action that's quite indecisive. There's nothing definite about any of those days. Down and up, all relatively short range and often closing pretty close to where it opened. So not a lot of change other than the market is in generally a bullish sort of sentiment at the moment. This is the NASDAQ versus the S&P, and that is still edging up very slightly, but it's certainly not rolling over. There is no evidence there of any sort of rollover. So that's the critical thing. And these are the ones that I look for. I'm looking for things like this, and that was all discussed last week. If you didn't catch last week's Sunday video, then it would be well worth having a look at that. This is consumer discretionary versus consumer staples, continues to move in favour of the more aggressive sectors of the market. So that is still a positive. S&P versus gold, not really doing much. There wasn't much change in either during the week. Semiconductors, always important. Now, admittedly, the strength in NVIDIA, which has now moved to become a $4 trillion market cap company, the first one in history. So that NVIDIA strength is feeding into this ETF, but nevertheless, the whole semiconductor sector is doing well, and that's healthy for the market. When we look on a sector-by-sector basis, in the US, no change in leadership. The banks fell a little bit, so that could be reflecting a bit of caution ahead of earnings season. So we'll have the major banks reporting this week, but otherwise, no real change there. And when we look at Australia, the information technology sector, which is in the blue, did cool off a little bit during the week. So energy remains strong, information technology down a bit, and all the rest pretty much unchanged. And finally, the S&P looking very similar to the NASDAQ composite. So down very slightly on the week. Now, if we look at currencies, the US dollar, this is on a daily chart. So the US dollar did manage to bounce a little, but it's pretty unconvincing, really. When you look at these candles, they're small range, they're indecisive. There's no real strength on that bounce at all. So the expectation has to be that the US dollar continues its downtrend, and that downtrend is pretty strong. So that's what the downtrend looks like. So this is just, at the moment, a bounce within the ongoing downtrend. The Australian dollar has firmed, but not to the same extent that the US dollar has fallen. So the Australian dollar, not exactly in favour. When you look at some of the other cross rates, that is certainly evident. So Aussie Stocks, 65.12 was where our dollar finished. And we're sitting in the middle of a 1 month band, which has been fluctuating up and down. And you'd have to say that, in particularly looking at not only the US dollar price action, but also US government policy to further weaken the dollar, further strengthening in our dollar would appear to be the easier path. Now, our index was down 0.3% for the week. But when you stand back and look at what's happened over recent years, the top few stocks, certainly less than 10, generate a massively disproportionate amount of the index gain. And so that's why my stance has always been not to place too much emphasis or decision-making around what the ASX 200 is doing. It's setting sentiment, and it certainly does that. But other than that, I don't think it's really at all reflective of what's happening underneath the hood in the Australian market. And it'd be okay if the growth in the value was there with those top 5 to 10 stocks. But the fact is that they don't really have the growth in the value that would warrant what's been happening with those stocks. And you've only got to look at the PE ratio of Commonwealth Bank over the last couple of years to see that The task that I'm always pursuing is to find the 50 to 100-ish, what I consider to be absolutely elite stocks that offer not only stunning long-term growth, but also high probability growth. You've got to have the two together. Many stocks have high potential, but many don't realise it. So you've got to have high probability as well. And certainly founder-led stocks can certainly improve your odds of success, that can provide that long-term growth and that long-term value because the growth rates are just so high. So that's the Australian market. Turning now to precious metals. Gold was up $20, which was 0.6%, to the mid-3300s. And in Australian dollars, that's 51.03. But the real big mover of the week was silver. Has really shot up very sharply. It was up nearly 4% for the week to 38.37. So that was the major mover. Gold stocks, the whole sector got shaken a bit by the NST cost escalation. Their all-in sustaining costs up significantly, and that caught the market by surprise, and that threw a bit of a wet blanket over the whole Aussie gold market. Whether it's temporary or whether when we start seeing some other results, the market deems that costs are much higher than they expected, and that certainly won't be positive. But look, profit margins and cash generation for the Australian gold producers is still very, very good. Before I go to Bitcoin, let's just look at gold and silver. So we'll look at silver first of all, and there's the big breakout that was building up on Thursday and then busted out on Friday. So if we pan back and take a big picture view, so we had this meteoric rise that occurred from the middle of 2010 that peaked out in the middle of 2011. So in 12 months, silver moved from below 20 and got to 50. So that's a huge move. And then since then, it's been pretty much all down until we started a new uptrend, which really started in March of this year in the mid-20s. And we're now starting to approach 40. So that is a very significant move. And you can see just how important this breakout was, because this was a very key level. We had likely resistance that met up with the peaks from October 2011, February 2012, and September of 2012. And then you could also throw in October of 2024. So this is a very decisive move in silver, and we've certainly seen in America, where there are some discrete silver producers or companies that produce a much higher percentage of silver, and they certainly moved very strongly on Friday. So that was the big precious metals mover of the week. There is the gold price in US dollars. So we're really in a consolidation zone here, which has been the case since around about April, so the last 3 or 4 months. And this is the Australian dollar gold price. Not much change there because our currency has been rising during that period. But the other big mover of the week was Bitcoin. And we had a particularly robust move on Wednesday and Thursday, and then managed to hang on to those gains and extend them to a degree on Friday, and finished at $117,500. And there are plenty of projections for Bitcoin to double or triple from here over the next year, 2 years, something of that nature. So that is a very significant move in Bitcoin. And as I've been observing over the last 6 months since I became a reluctant convert to cryptocurrency, the level of institutional acceptance of cryptocurrencies and stable coins is just accelerating. There's no question in my mind. I think we've now passed the point of no return, where cryptocurrencies and institutional involvement has reached a tipping point and taken off, that it won't be coming back to irrelevancy as some people have been forecasting. So that was a very impressive week for Bitcoin. Okay, so a big breakout there. Turning to other commodities, copper also had a huge week, up to $5.58. And you'll see on the chart in just a minute just how meteoric that has been. Now, of course, the driver of that was Trump talking about 50% tariffs, and that, of course, spurred some immediate buying in copper ahead of the tariff imposition. Nickel was pretty much unchanged, but the surge in copper, as we'll see, to new all-time highs is very, very significant, both fundamentally and technically, because this was a multi-decade breakout in copper. And crude oil edged up a bit to 68.75. But for me, crude oil is just all too hard. Too many forces that are not remotely predictable, and they just hit you from left field. So I have been of the view for the best part of the last decade that it's just not an area that has the sort of probability of successful outcomes that I look for. So I'll leave it to others to decide about crude oil. And I just observe that Woodside is trading at the same level today as it was back in 2005. So there's been no capital gain in Woodside in that period. Now, yes, they've paid a dividend, sometimes a very healthy dividend, but nevertheless, for those looking for growth, you certainly don't find it with a high degree of reliability in this sector. All right, there's the spot copper chart. So there's the significant move above $5. And if you pan back to a multi-decade picture, it's even more robust. And if we go back, just go back one. So you can see here we've had a wedge formation building up. So we've had resistance here around $5 that's been hit on multiple occasions, and we've had rising troughs, and then we've finally got a breakout. Because it's over such a big period of time, over multi-decades, this is a very significant technical breakout. Now, that doesn't guarantee that it just keeps going. But when you combine that with the fundamental situation, the long-term supply and demand scenario, so you've got a hugely conducive and logical balance between supply and demand, and you've now got a multi-decade breakout, it really does heighten the probabilities around copper, and we're starting to see copper developers starting to respond to that as well. As uranium coming off the boil, got up into the high 70s a couple of weeks ago. We're now back into the low 70s. Uranium keeps on doing what it does best. It's a bit unpredictable. And there's crude oil as well, not a lot happening there. So to wrap it up, final thoughts, I think it's time to maybe just recheck your sector weightings depending on what it is that you need. So the first thing you've got to do is to understand who you are as an investor. Are you someone that needs to sidestep a 6-month correction, or are you okay with that? You've got confidence in the quality of the assets and the value of the assets that you own, so you're not going to be too fazed by a 3 or 6-month correction. And you get a different answer for different people. There is no one size fits all, and that's why listening to commentators who say, you should do this or that with respect to the market is just not correct, because everybody is different to a degree. So you've got to make up your own mind about what sort of investor you are, but just be clear on the simple basics, because the rotations, which could be spurred by the US CPI for June, and certainly for earnings season, and particularly watching profit margins, that could really spur some significant rotations very, very quickly. I'm not saying it'll happen. It may not. The market might just continue on as it is. But I think we're in an environment where it wouldn't surprise me to see some sudden and fairly quick rotations. So just recheck your sector weightings and make sure that you're not holding a high weighting in something that was last year's story. That's the greatest danger, that you just blissfully carry on as though last year's winners are going to be this year's winners and next year's winners, because that's incredibly unlikely. So clarity of purpose is essential. Are you someone who can just sit calmly through a 3 to 6 month correction if it came, or do you need to do something about it? The key point is you don't have to react to a correction. It's optional. If you're that kind of investor and you own quality, high probability stocks, then you have the option to do nothing. And if you've done your job well and you do own high probability and quality, then you're probably going to be better off by doing nothing. It's just the psychological challenge in the middle that is the issue. The biggest danger is the investors who sell late. So they decide that they can sit through whatever, and they're quite happy about that at the start of a decline. But we get 6 months into the decline and they start to fret, and then they start to panic, and then they sell, and they sell at the worst possible time. That's the danger. So of the three alternatives, do something early, do nothing, or sell late, it's pretty obvious that there's only one of them that you absolutely do not want to do, and that's sell late. So that's why it bears some thinking about at the moment. Portfolio analyst this week, there's going to be some more Q&A, and Q&A of late has been exposing some real gems and some really good learning points as well. So there's a 14-day trial for $1 available for anyone that hasn't taken that. And that wraps up this week. I'll be back with you next Sunday. There's my email address, and there's more information on the website. Cheers.